Hello and welcome to Market Domination Overtime. Stocks closing mixed, and our very own Inez Ferre has the very latest. Inez.
Yeah, Josh, just taking a look at the Dow right now. The Dow up just 0.1%. So the Dow now on the third record close in a row. And then the NASDAQ composite down about 0.6%. The S&P 500 down 0.3%. So we have seen some selling going into the close. It was close there on whether or not the Dow would hit another record close. But just take a look at some of the trending tickers. I do want to note that we have seen some wealth management stocks that have been under pressure. Charles Schwab down more than 7%. Some other financial related stocks, LPL Financial Holdings also down 8%. This is because of a new tool that was announced by an AI startup. And basically this tool is threatening the wealth management industry because it's a tool for financial advisors to be able to customize the strategies for clients, similar to what you saw with software companies. Now it's hitting the wealth management industry as well. Taking a look under the hood with equities, we are seeing today, you saw utilities in the green, materials, real estate also in the green. Over on the Dow, you can see a mixed picture there with on the Dow, but Home Depot and Disney were the Dow leaders today. And over on the NASDAQ 100, pretty much the Mag 7, except for Tesla, all slightly lower, Josh.
All right, thank you, Inez. Well, we're getting the pulse of the retail trader now. Schwab's latest stacks report highlighting that they were buying the dip amid the market rout. Joining me now, we got Joe Mazzola, Charles Schwab, head trading and derivatives strategist. Joe, my friend, always great to see you. Let's dig into this. So the stacks just hit its highest level, Joe, you say here, since February of last year. What does that suggest to us, Joe, about how retail investors are feeling right now?
I think you need to kind of break the retail investor into a couple different cohorts here. So, what it says to me is that they're continuing to buy the dip. It tends to be more on the active side, though. So the traders over investors are feeling a little bit more bullish. They're more active in looking for opportunities. A perfect example would be the number one stock on the list, Josh, and that was Microsoft. So day after earnings come out, stock pulls back 9%. We see about a $1.7 billion kind of net inflow into the stock from clients that are looking for those opportunities. Now, what's interesting in addition to that is it's been through some different sectors. So IT has been the biggest lift that we've seen in terms of the stacks, but that hasn't always been the case, right? So October really through November, I saw some heavy selling in IT and then moving a little bit more towards that rotation trade that you've seen in the market over the last couple of months. But in January, that's when we saw kind of our more active investors come back in, look for some opportunities, maybe some of those beaten up tech names. And I think that is what you're going to see kind of going forward. And it's been a little bit of the history of the stacks is they look to buy the dips and kind of sell the rips.
And these popular names, I mean, you mentioned Microsoft. The most popular ones, though, Joe, to your point there, I see Microsoft there, I see Netflix, Tesla, Amazon, NVIDIA makes the cut.
Yep.
How would you break down the common theme or maybe themes joining those?
Sure. Let's go back with Microsoft, 9% pullback off of earnings. Amazon pulled back off of its earnings. These were names that have been kind of heavily bought and sold. Tesla's, I think, the perfect example. That really is something that our clients love to trade. When it gets to the top of the range, gets closer to the 52-week highs, it's usually number one and number two on the sell list, right? But then once it starts to kind of pull back a little bit and they recognize an opportunity to buy in shares 10, 15% lower than where they were trading the previous month, they're buying those in. So there's a lot more activity that's going on than maybe what we've seen in the last couple of years, at least in the last few months on the sell list. AMD, here's what was interesting about that. So AMD came out with earnings post stacks, right? So stacks for January ended on the 30th. At that time, AMD was really close to a 52-week high. So that was right before earnings came out. They sold it. They sold it into strength. I would not be surprised as we start to look over the weekly stacks if that starts showing up on the buy list once that stock pulled back a bit. So that's kind of a common theme, right? They're looking for opportunities when some of the more popular stocks pull back.
Yeah, I see net selling here, the list. So AMD, you got Lisa Su's company there. I see Costco, Boeing, there's CoreWeave and Alibaba. Talk about the Fed just for a minute, because I just get your take there, Joe. They did obviously, of course, they decided to pause last month. Do you think that decision, how, if at all, do you think might have impacted retail investor behavior, investing?
So I'm going to hit that from two angles, if you don't mind, Josh. So I think right now the Fed's in a little bit of a difficult situation, with the retail sales number that came out today, showing that there's some weakness with the consumer, and it really comes down to jobs, right? This idea that if I'm not feeling as comfortable that I can move or find something where I can get a higher paying job or even maintain my job, I'm probably not going to go out and spend on the discretionary items that I might have in the past. And so I think that they're at this inflection point where they have to decide, do we really want to kind of slow down the growth in order to preserve this burgeoning job market, or the job market that's pulling back a little bit? So I think that's interesting. Where I think that bleeds over into investor decisions is once again, I think it kind of goes back to the cohorts. We look at generational trading and investing as well, in terms of versus traders and versus investors, active versus non-active. And what we've seen is on the generational side, Gen X continues to kind of pull away from Gen Z in terms of how much they're buying and their bullish sentiment. I think a lot of that has to do with the fact that they're probably in the top 10% in terms of the consumers, and I think that they feel a little bit more comfortable in the fact that they have that discretionary income to spend and to invest in the market. I think if you were to look at Gen Z, there's probably a little bit more concern in terms of their discretionary income and whether or not they're going to have jobs and the push of AI. That's kind of what we hear, at least when we ask for the attitudinal survey as well.
As a longtime market watcher that you are, Joe, I'm interested to get your thoughts on another theme. We live in this world now, Joe, where every morning you can wake up and you hear, hey, good news, AI is coming after your industry. It's coming after your vertical, your sector. Happened in wealth management today, right? I'm not asking you to comment on that headline, Joe, that news, but more broadly, just your thoughts about how, as an investor, Joe, you're just supposed to navigate that.
Really interesting question, Josh. And I think that you have to look at it in terms of maybe what inning are we in. I think a couple of years ago, it was really just determining, okay, who are the chip makers that are going to benefit, and where as an investor do I want to kind of plant my flag and say, these are the people that are going to do really well? Because here's the thing, they've done well. The stock has done well. Those stocks have split. You know what they are. You know those names, the AMDs, the NVIDIAs. But they to a certain extent have maybe topped out a little bit. So now I think investors are looking to see, and they're saying, okay, where's the inference model? Or, what's the next leg in this trade, and where can we find some value? A couple months ago, it was looking for energy providers for AI trade. And there'll always be another step, and there'll always be another sector or industry that investors are going to kind of look towards. It's just a matter of identifying that early enough.
Joe, as always, great to have you on the show. Thank you.
Thanks, Josh.
Let's turn now to some earnings. As Ford's fourth quarter results, they are just hitting the wire. And Yahoo Finance's Pras Subramanian joining now with a look at the numbers. Pras, what do you think?
Yeah, fourth quarter results are here. Missed expectations on profit, and a lot of losses coming from the EV business, right? So Ford reported Q4 automotive revenue of $42.4 billion that matched estimates, but adjusted EPS came in at 13 cents versus 18 cents expected. 18 cents expected on adjusted EBIT of $1 billion versus $1.16 billion estimate. Now, for the fourth quarter and the full year, it reported a net loss of $11.1 billion and $8.2 billion respectively, which reflects the special items like those EV charges it took back in December. Ford's full year adjusted EBIT of $6.8 billion came in near the forecast of $7 billion, but missed estimates of $8.86 billion. Now, that Ford Model E EV unit reported a $4.8 billion EBIT loss for the year. It's an improvement compared to 2024, but still, nonetheless, nearly $5 billion are in losses. So looking ahead at 2026, Ford projects adjusted EBIT of $8 to $10 billion, which is good. Adjusted free cash flow of $5 to $6 billion bucks, and CapEx of $9.5 to $10.5 billion. Now, Ford Also expect the Model E EV business unit to lose another $4 to $4.5 billion, and they don't see that becoming profitable until 2029 at the earliest.
All right, Pras, thank you. Robinhood, fourth quarter earnings, they are just now crossing the wire. Let's get you those numbers. I see Q4 EPS of 66 cents. I don't see a comp for that yet. Q4 net revenue, though, let's look at the top line, $1.28 billion. The street was closer to $1.35 billion. Transaction-based revenue looks like it also comes in a bit light versus consensus, $776 million. Analysts had been expecting more like $791.6 million. I'm just looking for crypto revenue. There it is. Q4 crypto revenue, $221 million. Consensus was closer to $248.2 million. Options revenue, $314 million in the quarter. The estimate was $331.2 million. 2026 adjusted operating expenses, the forecast for operating expenses in SBC is $2.6 to $2.73 billion. At least initially here, you can see the stock, we're down a quick 8%. Now remember, heading into this print, the stock had been interesting. You were still up about 50% over the past 12 months, but you were down heading into this print about 40% from the all-time high last October. You got some big questions front and center for investors. The impact of this crypto winter we've been talking about, what does that mean for Robinhood and its financials in the quarters ahead? What is that going to mean for trading volumes? What's going to mean for EBITDA? Questions around that options trading business. That, remember, is the company's largest business, so there'll be lots of questions about what are the catalysts still ahead there. So we are down here about 9% now in the after hours. Analysts, though, it's worth mentioning, still very bullish on this name. More than 80% of analysts still do tell their clients Robinhood is a buy. Coming up, we're going to get analyst reaction to Robinhood earnings. That's next on Market Domination Overtime. Robinhood shares sliding here as fourth quarter revenue missed expectations. Joining me now is Christian Bolu, senior analyst at Autonomous Research. Christian, it's good to see you. So Robinhood reports we're down right now, nearly 8% in the after hours. Christian, what do you make of the print? Your first thoughts?
Yeah, afternoon and evening. Thanks. Good to see you. I would say, look, an expensive stock and a top line miss is not helpful at all. Also, there was some deceleration in some key metrics. Things like the net deposit growth decelerated in the fourth quarter and looks to have continued to decelerate in January. So I do think the reaction might be warranted here, just given high expectations and I would say obviously a very expensive stock. That being said, the commentary from the management team is pretty constructive in terms of the pipeline for 2026 in terms of new business growth, and actually transaction volumes have been very strong in January as well. So the outlook here is actually pretty decent.
Let me ask you, Christian, heading into this print, the stock was already, it was off about 40% from that all-time high in October. And a big question, this, of course, for investors right now is they're trying to gauge how this company is going to navigate, Christian, this crypto winter, right?
Yeah.
This route in Bitcoin. You know this company backwards and forwards. As an analyst, how do you think about that? What is it going to mean, Christian, for Robinhood's trading volumes, for EBITDA? How do you model it?
Yeah, so crypto has fallen as a percent of revenues. It's come down from north of 20, and over time we think it will be near a 10% of the business. If you run through what a crypto winter would look like, so if you look at where trading volumes troughed in 2022, 2023, it would imply something like a 50% haircut to current trading volumes. If you run that through the P&L, it's only about a 10% hit to Robinhood. So Robinhood's EBITDA. So not great, but completely manageable. In fact, over time, we think things like event contracts and prediction markets will be a bigger part of the business than crypto. And obviously, the actual biggest business, which is options trading, continues to do extremely well. with really strong volumes or record volumes to start 2026.
Christian, would you argue that Robinhood, are they in any way better positioned during this Bitcoin drawdown than prior drawdowns because they've diversified the product lineup or the regulatory backdrop? I'm curious to get your thoughts there.
Yeah, it's definitely a different winter. I would say we are surprised about how severe crypto prices have come, given we should have a more constructive backdrop for crypto. And so it's been somewhat surprising. But from Robinhood's business perspective, they're definitely better set up. This is a much more mature company, a much more diversified company, not just in terms of the types of transaction businesses it has, but also just the types of businesses it has. It has a net interest income is a much bigger part of the revenue stream. They have things like retirement, launching a banking product with credit cards. So this is much more of a money app that is in many, many businesses and way more diversified than in prior periods. And just from a business perspective, better managed, more disciplined on expenses, very profitable company. So all these things set up the company very well for, let's say, a crypto winter.
What about options trading, Christian? Because as you know, listen, biggest business for the company. I think it's something like 25%, Christian, of revenue. What are the catalysts you see ahead for that business?
I would like the businesses a lot here. So options, for the most part, have been options penetration, i.e., just how many options are being used relative to the underlying equity market, has been growing for the last 30 years. And has only accelerated in recent times, partly because of firms like Robinhood that have made it easier to use and understand and increased accessibility. Also, products like zero-dated options that give you much more precision around risk management have also driven significant adoption of options. So we did some analysis on this, and we think you could see something like 40% incremental growth in the options business because of all the penetration we're seeing, the new products, and a normalization of what we call options penetration. So, pretty constructive on options. And as I said, that's the biggest business. It's less cyclical, believe it or not, because people can trade options in up and down markets. It can be used to generate yield. It's a very flexible product. And Robinhood offers basically the best value. They charge the least relative to the bigger players out there. So there's a value prop from using the platform. There's a great UI, and the underlying market is growing very fast. So I think a really good business for Robinhood long term.
You mentioned, Christian, the company's moving to prediction markets. How confident are you about the growth story there long term, Christian? Especially, listen, they certainly have plenty of competition, right?
Yeah, it's a good point. So there's a lot of competition. The good thing about Robinhood is their value prop from a business perspective is the distribution. There's not many folks that can distribute or have the distribution that they do. So there could be a lot of competition around the products, Kalshi, Polymarket, the exchanges. Everybody can launch their own product, but they all still need the pipes to distribute that through. And that's where Robinhood really stands out. It's not just that they have the numbers, they have the type of customers that really, where prediction markets really appeal to. And you see it in the numbers. So despite the increasing competition, I actually see Robinhood coming out as a winner here. And if anything, they can actually monetize better over time as they build their own platform, right? They just announced a partnership with Susquehanna that gives them much more control of the economics, gives them much more ability to be faster around product innovation. And prediction markets are tiny relative to broader futures markets, broader options markets. So the pathway for growth here is pretty significant.
Christian, so good to have you on the show today. Appreciate that instant analysis. Thank you, sir.
Thank you.
Time now for to watch Wednesday, February 11th. The wait is over. The January jobs report is coming after a brief delay due to the government shutdown. In addition to the usual payrolls and unemployment rate, we're also getting major benchmark revisions that could sharply lower how much hiring actually did happen in 2025. Some economists warning the labor market may be closer to stalling out than previously thought, a read that could reshape expectations for Fed policy in the months ahead. And turn to earnings, some more big names on Wednesday: T-Mobile, Shopify, and Hilton. They are all reporting Wednesday morning. AppLovin coming in after the markets close. McDonald's also out after the closing bell. Analysts expecting U.S. same-store sales to pick up in Q4, driven by value-focused offerings like the extra value meal and a boost from the Monopoly promotion. Investors will also be watching margins as well as guidance for the rest of 2026. Another name to watch, Cisco Systems. It's reporting second quarter earnings. Analysts anticipating resilient enterprise networking demand with AI-related infrastructure spending providing incremental upside. And to round it all out, new commentary from the Federal Reserve is coming on Wednesday as markets weigh whether the latest labor data gives the Fed more room or more reason to stay patient. Well, that's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned.